Hello everyone. Now let's talk about natural resources. And natural resources is part of the long-term assets. So some businesses own natural resources such as timber or timberland, minerals or oil. So the characteristics of natural resources are as follows. First, they are naturally occurring. In other words, an asset that is created through natural growth or naturally through the passage of time. So for example, timber is a natural resource that naturally grows over time. It also removed for sale. The asset is consumed by removing it from its land source. So for example, timber is removed for use when it's harvested and minerals are removed when they are mined. Also another characteristic is that it's removed and sold over more than 1 year. So the natural resource is removed and sold over a period of more than 1 year. If it's less than a year, we don't consider it to be a natural resource. So as natural resources are harvested or mined and then sold, a portion of their cost is debited to an expense called depletion expense. So depletion is determined as follows. The first step, we determine the depletion rate, which is very similar to the depreciation. So the depletion rate is equal to cost of resource divided by the estimated total units of the resource. And then the second step would be multiplying the depletion rate by the quantity removed from the resource during the period. So we're going to calculate the depletion expense as the depletion rate that we calculated in the first step multiplied by the quantity removed. I would say this is very similar to the depreciation using the units of production or units of activity. And of course it has the same idea as the straight line depreciation, but I think this is more similar to the depreciation method which applies the units of activity or units of production. So let's see an example. Assume that Karst company purchased mining rights as follows, where we have cost of mineral deposit to be 400,000, we have estimated total units of resource to be 1,000,000 tons, and then tons mined during the year to be 90,000 tons. So the depletion expense of 36,000 for the year is computed as follows. So the first step is to calculate the depletion rate, which equals to the cost of the resource. In our case here is 400,000, and the estimated total units of the resource is 1,000,000. So that would give us 40 cents per ton. Tons mined during the year are 90,000, so we take the 90,000 multiplied by the 40 cents, and that would give us $36,000. So the depletion expense for the year would be $36,000. So the adjusting entry at year end would be as follows. On December 31st, we debit depletion expense. Instead of depreciation, we use depletion expense. And then we credit accumulated depletion. And the value here is 36,000. So very similar to accumulated depreciation, we have the accumulated depletion, which is a contra asset account. It's reported on the balance sheet as a deduction from the cost of the mineral deposit. Now let's talk about intangible assets. So long-term assets that are used in the operations of the business but do not exist physically are called intangible assets. So we like to call intangible assets assets that lack physical existence. They don't physically exist. So unlike other fixed assets where we have or like property, plant, and equipment like a building, land, furniture, equipment, these are assets that are existing physically, and we call them tangible assets. But intangible assets, these are the assets that don't physically exist. And just to give you a simple idea, something like a copyright or a patent for an idea, or we'll talk also about something called goodwill. So all of these are considered to be part of the intangible assets. So intangible assets may be acquired through innovation, creative activities, or from purchasing the rights from another company. One of the well-known companies for purchasing intangible assets, especially ideas and patents, is 3M. 3M is a company that is built on different ideas, and most of them they buy them from other companies. Of course, they still have their own R&D department where they develop their own ideas or own patents, but they also buy patents from others. So the accounting for intangible assets is similar to that for fixed assets. The major issue are determining the initial cost and determining the amortization, which is the amount of cost to transfer to expense. So I want you to remember, for fixed assets, or to be more specific, for plant assets or property, plant, and equipment, we use the term depreciation. For natural resources, we use depletion. For intangible assets, we use amortization. So amortization results from the passage of time or a decline in the usefulness of the intangible asset. So let's see the first example of intangible assets, which is patents. Manufacturers may acquire exclusive right to produce and sell goods with one or more unique features. Such rights are granted by patents, which the federal government issues to investors. And these rights continue in effect for 20 years. A business may purchase patent rights from others, or it may obtain patents developed by its own research and development. The initial cost of a purchased patent, including any legal fees, is debited to an asset account. This cost is written off or amortized over the year of the patent's expected useful life. The expected useful life of a patent may be less than its legal life. So in some cases, we have a patent on an idea. We know it's legally it can be ours for 20 years, but in reality it's only good for 5 or 6 years, and we don't expect it to last longer than that. So in this case, the expected useful life would be less than the legal life. I give you a classic example, like the fidget spinners. I hope you still remember these. I'm sure this was a patent, it was an idea, but I don't think it lasted for 20 years. It only lasted for maybe less than a couple of years. So patent amortization is normally computed using the straight line method, and the amortization is recorded by debiting an amortization expense account and crediting the patents account. A separate contrasted account is usually not used for intangible assets. So we don't do the accumulated amortization account. We don't have that. So let's see an example. Assume that at the beginning of the fiscal year, a patent acquires, or a company acquires a patent right for $100,000. Although the patent would not expire for 14 years, its remaining useful life is only estimated as 5 years. So the adjusting entry to amortize the patent would be as follows. We're going to debit the amortization expense, credit the patent directly. So we're not using accumulated amortization. We credit the asset, the intangible asset directly. And how did we get the 20,000? It's just 100,000 divided by the expected or the estimated useful life of that patent, which happened to be the 14 years. So don't use the 14 years. What if the legal life is less than the estimated useful life? Then go with the legal life. So whatever is lower, we have to use it. So we took the 100,000 divided by 5, and it's $20,000. Some companies develop their own patents through research and development. In such cases, any research and development costs are recorded as current operating expenses in the period in which they are incurred. So we don't capitalize it. Only a few cases, especially in IT businesses, they're allowed to capitalize it or record it as an asset. But again, this is something a little bit advanced, is beyond our interest for this course. Now let's talk about copyrights and trademarks. So a copyright is the exclusive right to publish and sell a literary, artistic, or musical composition. Copyrights are issued by the federal government and extend for 70 years beyond the author's death. The cost of a copyright include all costs of creating the work plus any other cost of obtaining the copyright. So remember, like if I wrote a book, this book is copyrighted for 70 years after my death. Okay, so it's not since it was written, it's actually after the death of the author. How about trademarks? A trademark is a name, term, or symbol used to identify a business and its products. For example, Nike, McDonald's, Apple, they all have their own trademarks. So under federal law, businesses can protect their trademarks by registering them for 10 years and renewing the registration for a 10 years period. So they have to keep renewing it. The legal costs of registering a trademark are recorded as an asset. Then another important intangible asset is goodwill. So what is goodwill? It refers to an intangible asset of a business that is created from such favorable factors such as location, product quality, reputation, managerial skills. In other words, it's the ability of the business to generate over the regular or above the regular kind of profit. So goodwill allows a business to earn greater rate of return than normal. So generally accepted accounting principles allow goodwill to be recorded only if it's objectively determined by a transaction. So in other words, the only way to objectively determine it by a transaction is by acquiring another business. So I cannot create my own goodwill. I cannot record a goodwill for my own business. I can only do that if I acquired another business and I merge it with my business. So unlike patents and copyrights, goodwill is not amortized. A loss should be recorded if the future prospects of the purchased firm become impaired. So in other words, goodwill is not subject to amortization, it's only subject to impairment. So let's see an example. Assume that on December 31st, Face Card Company has determined that $250,000 of the goodwill created from the purchase of electronic systems is impaired. In this case, we're going to debit the loss from impaired goodwill and credit the goodwill directly. Remember, goodwill is an asset. We want to reduce its value, so we're going to credit it for $250,000, and we're debiting the loss, which is very similar to an expense. It also shows on the income statement, and we call it loss from impaired goodwill for the same value. So this table, I think, gives us a good comparison between those intangible assets, the patent, the copyright, the trademarks, and the goodwill, their description, their amortization period, and the periodic expense, how we call it. Like for patent and copyright, they're subject to amortization expense. Trademark, there's an impairment. Goodwill, also there's an impairment loss. So financial reporting for long-term assets, how we present the fixed assets and the intangibles in the balance sheet, to be more specific. And of course, for the depreciation, expense, amortization, and the depletion, these are going to be presented on the income statement. So in the income statement, depreciation and amortization expense should be reported separately or disclosed in a note. A description of the method used in computing depreciation should also be reported. On the balance sheet, each class of fixed assets should be disclosed on the face of the statement or in the notes. The related accumulated depreciation should be also disclosed either by class or in total. The fixed asset may be shown at their book value, which is the cost less its accumulated depreciation. Sometimes we refer to it as the net book value, which can also be described as their net amount. If there are many classes of fixed assets, a single amount may be presented on the balance sheet, supported by a note with a separate listing. So we combine them together. So fixed assets may be reported under the more descriptive caption of property, plant, and equipment. So I personally like the term property, plant, and equipment. I think it's used nowadays more often than the term fixed assets. So intangible assets are usually reported on the balance sheet in a separate section following the fixed assets. The balance sheet or the balance of each class of intangible assets should be disclosed net of any amortization. And here we have an example for McDonald's where we can see the property and equipment, $39 billion, and their accumulated depreciation is about $14.89 billion. So the net property and equipment would be the difference, which is about $24 billion. And then they have the intangible asset goodwill, $2.6 billion. And then in the notes, they broke down the property, plant, and equipment, include like they have the land, the building and improvements, equipment, and other, and total cost. And of course, this value matches the property and equipment value. So this is in the notes of the financial statements, or what we call it the disclosures or the footnotes. So the last thing in this chapter is to run some ratios or see how the ratios can be helpful for us. So one of the important ratios that we're going to learn in chapter 9 is the fixed asset turnover ratio. And it measures the number of sales dollars earned per dollar of fixed assets. So higher the ratio, the more efficient the company is using its fixed assets in generating sales. So fixed asset turnover ratio is calculated by sales divided by average book value of fixed assets. So, or simply average fixed assets. So sales is the revenue or the sales revenue from the income statement, and the fixed assets is from the balance sheet, and of course the term average means beginning plus ending divided by 2. And how we get the beginning, it's the ending of the previous year. So let's see some analyses for McDonald's. They have their sales of 21 billion. Their fixed assets at the beginning of the year was 22.8 billion, and then of the year 24.16 billion. So the ratio would be calculated as 21 divided by the average of the assets, which is again beginning plus ending divided by 2, and that would give us 0.9. Or in other words, yeah, it's 0.9. I don't want to say 90%, but it's 0.9. So it's always good to compare companies in the same industry. So for McDonald's, it's 0.9. For Wendy's, it's 1.7. Jack in the Box is 2.57. Chipotle Mexican Grill is 3.94. And a company called Yum, it's 4.65. So you can see that McDonald's is the lowest when it's compared. So it simply says here that for every dollar invested in fixed assets, the company generates 90 cents in sales. Of course, for other companies, they're much more productive. So it seems like McDonald's, and they're investing a lot in fixed assets, and maybe they own a lot of their, I don't know, stores or something. I don't know what's. I know McDonald's is a franchise, so I don't know what's the reason behind that. So other ratios that you can see, but of course it might vary from business to another. So Disney, for example, it's 2.3. ExxonMobil, which is petrochemical, 1.1. Macy's, a retail store, 3.8. Manpower Group, temporary employment, it's 141, and it seems like they don't have a lot of fixed assets, and that's why they're very productive here. McDonald's was less than 1, and Union Pacific, which is a railroad, huge investment in fixed assets, and that's why it's only 0.4. So I hope this was helpful, and you gained some knowledge here about fixed assets and long-term assets and intangible assets. So let me know if you have any questions, and good luck.